Hi, my name's Dorian. I'm the senior loan writer at the Bank Said No website, and today we're going to have a bit of a look at low doc loans. Um, they've changed significantly over the last 15 years, ever since the global financial crisis, and a lot of people don't really understand what they do and how you can use them for borrowing. So we're just going to go through a bit of a history and bring you up to date with where they are now. Low doc loans are essentially a loan for self-employed people. And in today's video, we're talking predominantly home loans. You can get low doc loans for car loans and on odd occasions in certain circumstances for personal loans, but we're going to talk about home loans for today. Low doc stands for low documentation, as opposed to a standard loan, which is a full doc loan. Full doc loans for self-employed people usually require 2 years worth of tax returns and financials to satisfy the lender's criteria that you can afford the loan. A low doc loan gets rid of a lot of the paperwork, especially if you've got multiple businesses, multiple companies, or you're maybe a little bit behind in your tax returns and haven't lodged them yet. Any number of situations could call for a low doc loan situation. And a low doc loan, back before the GFC, the global financial crisis, a low doc loan was effectively a piece of paper where you said what your business was, what your ABN was, and you wrote down a figure which you thought was your income. And the banks would take that as written proof that you can afford the loan. And it was a bit of a cavalier sort of a time in lending. And it was partly the reason why the global financial crisis happened, because there were a lot of those sort of loans going on in the United States, and the market collapsed, and that sort of lending really couldn't be done anymore. So after 2008, in 2011, regulating home loans changed from being a state-based thing to being under the watchful eye of the ASIC, and of course APRA and the ASIC got together. APRA is the regulator for the banks, so they like to make sure that the banks are in a good financial position, and the ASIC makes sure that lending is done fairly and in a good and proper way. So the ASIC brought out licensing in 2011. All lenders and all brokers had to get some sort of license. There are a couple of different varieties. We have a full credit advising license, so we're able to offer a wide range of home loans for all sorts of different situations. And how that changed low doc loans is that the banking regulators came in and said, look, you've got to do a little bit more than just get a piece of paper with a figure on it to determine whether these people are able to afford a loan without financial hardship. And that's a key statement in home lending in Australia, is without financial hardship. And that's why banks do serviceability tests. They make sure that you can afford the loan and you're not going to get into trouble if something goes wrong. So with low doc loans, they stopped being a one-page piece of paper, and lenders turned around and said, okay, we need to work out a different way to be able to verify your income if you're self-employed. So some of them turned around and said, well, we'll be happy if you give us 12 months worth of your BAS statements, then we can work out your income from that. Other ones said, well, if you give us 6 months worth of business bank statements, we should be able to work out your income from that. And other ones turned around and said, oh, well, we want a letter from your accountant to verify what you earn. And there are other ones that wanted any combination of those three. A lot of lenders, particularly the mainstream banks, dropped out of low doc loans. It was all too hard. And they left it to some of the more boutique banks and the specialist lenders to pick up the slack and really specialise in those sorts of areas. So low doc loans now are really an alternate verification situation. And providing you've got some other form of income, like the BAS statements, the accountant's letter, or the 6 months worth of business bank statements, then we are a real chance of being able to get you a home loan without necessarily needing the full tax returns and financials. and that's possible for construction loans. It's possible for purchases if you want to buy a property, whether it's an investment property, owner-occupied property, whether you want to refinance or do a debt consolidation. Low-doc loans apply across the board in those situations. The only time a low-doc loan is not impossible but particularly difficult is if you are credit impaired and you want a construction loan. That one really has never been solved by any particular lender. Certainly if you're low-doc and you're credit impaired and you want to buy a property, or we've done low-doc credit impaired loans for people who are ex-bankrupts, providing you can satisfy the other lender's criteria and prove that your income is now good and you've got a suitable deposit, all that sort of stuff, then all these loans are available to you. So through mainstream lending at mainstream rates, then your low-doc loans are up to about 80% of the value of the property, whether that's a refinance or a purchase. Some of the specialist lenders will go up to 90% of the value of the property in a low-doc loan. However, the interest rates are a little bit more expensive. Having said that, they're still certainly well and truly affordable. It's not like the dodgy shark loans from 10 years ago that were charging horrific interest rates like credit cards. The modern low-doc loan really isn't a hell of a lot more expensive than a mainstream full-doc loan. You'll be paying a little bit extra, but it's nothing to be too concerned about. I'd certainly rather be in my own home and paying a slightly higher interest rate using a low-doc loan than not having a house at all, for example. So irrespective of what your scenario is, if you're self-employed, whether you've been self-employed for 1 year, 2 years, even 6 months, it is still possible. It's because of the range of lenders have so different requirements. It really does need an email or a phone conversation to work out which lender is most appropriate for your situation, and then we can start working on how to do an application from there. So if you want to give us a call on 1300 139 883, or shoot an email through the link on the website, and let's get in contact and have a bit of a conversation, and let's see if we can help you with a self-employed low-doc loan and get you the finance you need. Thanks for that. I'll speak to you later. Cheers, bye.